$408,800. That's the median price of a home in America right now. Not in Manhattan, not in Beverly Hills. The median, the middle of the country, the average Tuesday. You are lying on the couch in an apartment that costs you $1,470 a month, and you are doing the math that doesn't work. You've done it 3 times this week. Same numbers. Same answer. You make $54,000 a year. You have $11,200 in savings. You have a credit score of 694 and a student loan payment that hits on the 15th like a clock. The house you grew up in, the one your parents bought in 2001 for $148,000, is now worth $390,000. You know this because you check Zillow on your phone at night like other people check Instagram. You check it the way you'd check a wound, just to see if it's gotten worse. You tell people you're saving up. You tell yourself you're being smart. But saving at your rate means another 4 years before you have enough for a down payment on something that might be worth less by the time you get there. The market is not waiting for you. It has never waited for anyone. This is where most people stay. Not because they're not smart enough, not because they don't work hard enough, but because they are optimizing for comfort when they should be optimizing for position. The two feel similar from the inside. They are not the same thing. You read a forum post at 11:30 on a Wednesday. Some guy, nobody famous, no credentials listed, talking about a house he bought in 2019 inches, Columbus, for $174,000. He put $8,700 down. He rented it out. The tenant paid his mortgage. 4 years later, he refinanced, pulled out $41,000 in equity, used it as the down payment on the next one. You read it 4 times. The math is not complicated. The math is almost embarrassingly simple. What is complicated is that you have spent your entire life being taught that debt is danger and mortgages are burdens. And here is this man describing debt as an engine. Something shifts, not a feeling. A framework. The first rule. At 0, your obstacle is not money. Your obstacle is that you are thinking about real estate the way a renter thinks about real estate, as a cost. The moment you see it as a vehicle, the whole road changes. You start studying the market in your city the way you used to study for exams. Except this time you actually care. You learn what a cap rate is. You learn what cash-on-cash return means. You learn what DSCR stands for and why it matters more than your W-2 when a lender is deciding whether you can carry an investment mortgage. You learn the difference between a Class A multifamily building with a 4.5% cap rate in a prime zip code and a Class B rental 3 miles outside of that zip code trading at 6.8%. You are not ready to buy either of them, but you understand the difference. Understanding is always the purchase before the purchase. You find the property on a Saturday morning, not online. Your coworker mentions it offhand in the break room. Her aunt is selling a duplex, wants to be done with it, needs to close before the end of the year. It's a 1960s brick duplex in a working-class neighborhood that has been quietly gentrifying for 2 years, 2 miles from a hospital that just announced a $200 million expansion. She's asking $218,000. The units are rented, both of them. The combined rent is $2,100 a month. You run the numbers in your car on a napkin. You run them again at home on a spreadsheet. You talk yourself out of it for 4 days. Then you call her. You put 20% down, $43,600. That takes you to 0. Your savings account, wiped clean. You feel the way you imagine people feel jumping out of planes, terrified and awake at the same time. Your investment property mortgage rate comes in at 7.1%, about 3/4 of a point above what your neighbor paid for his primary residence, which is the way it always works when the bank knows you won't live there. Your monthly payment is $1,174. Your units bring in $2,100. After taxes, insurance, and a maintenance reserve, you set aside $200 a month without fail. You clear $486 a month. That is not life-changing money. You know it is not life-changing money, but you also know that someone else is paying your mortgage every single month. 2 people you have never met are building your net worth 1 payment at a time. That is a different kind of feeling than a paycheck. You do not quit your job. You do not tell everyone you know. You do not start a podcast. You deposit the rent. You fix a water heater when the tenant calls at 7 p.m. on a Thursday. You learn what a P-trap is. You learn that a property manager will cost you 8 to 10% of gross rents, and that at your size, right now, you cannot afford to hand that margin away. So you manage it yourself. Every decision teaches you something the textbooks don't have. The appliance that breaks on Christmas Eve. The tenant who pays 2 weeks late but always pays. The neighbor who calls to say the gutters are overflowing. These are not problems. These are tuition. 18 months later, the duplex has appreciated. Not dramatically. Modest. Enough. The neighborhood is exactly what you thought it was becoming. A coffee shop opened on the corner. Then a CrossFit gym. Then a small brewery. The hospital expansion broke ground. Your Zillow estimate, which you now look at with a different set of eyes, shows $261,000. You have $46,000 in equity. The cash flow has continued. You've saved $14,000 in that time from your job, even with the property expenses. You are 29 years old. Your net worth is $68,000. That number was 0 2 years ago. The second rule: the house someone else pays for is the only house that makes you richer while you sleep. Everything else you own is just furniture. You refinance the duplex, pull out $28,000 in equity. It increases your payment by $188 a month, and it feels wrong in your stomach the way it always does when you pull money you didn't think you had. But you understand now what that Columbus guy understood. You are not spending the equity. You are repositioning it. You use $22,000 as the down payment on a single-family rental. A 1,400 square foot ranch house in a suburb where the median rent for that size is $1,480, and the purchase price is $197,000. You close in 43 days. Your investment mortgage rate is 7.3% on this one. You spend 3 months before that closing, making yourself a better borrower, paid down a card, let 2 hard inquiries age off, moved money in the right accounts at the right time. You learned what lenders actually look at. Then you looked at yourself the way they would. You now have 3 units, 2 in the duplex, 1 in the ranch. They bring in $3,580 a month combined. Your mortgages total $2,190. After reserves and insurance, your net monthly is $847. Your day job still covers your life. The real estate is separate. It is a machine you are building on the side, and it runs whether you think about it or not. You start thinking about it constantly. You are 31. Your real estate portfolio is worth approximately $458,000. Your outstanding loans are $302,000. Your equity is $156,000. The number feels unreal. You check it the way you used to check your bank balance at 11 p.m. Not from anxiety, but from disbelief. You spent your 20s watching a $408,800 median home price feel like a wall. Now you are sitting on 3 times that in equity. You built in 5 years through decisions other people said were too risky. You drive the same car. You eat lunch at the same places. Nobody at your office knows about any of this. You've noticed that talking about what you own makes people strange. Either they want a piece of it or they want to explain to you why it won't last. Neither conversation is useful. You've developed an allergy to both. You find a 6-unit apartment building, built in 1971, all rented. 2-bedroom units in a mid-sized city where the vacancy rate is 4.2% and rents have climbed 2.9% annually for 3 consecutive years. The asking price is $640,000. The current net operating income is $41,200. You do the math. That's a 6.4% cap rate. For this market, that's a number worth paying close attention to nationally. Apartment cap rates sat at 5.7% in 2025, and this is better. You spend 6 weeks underwriting the deal from every angle. You find things the seller didn't disclose. You use those things to negotiate $38,000 off the price. You close at $602,000. You bring in $82,000 from a private money lender. You've spent 8 months building a relationship with coffee, quarterly updates, 2 dinners where you never once asked for anything. The lender makes 9% on their money. You get a building. Everyone wins. This is the transaction that changes the texture of what you're doing. Before this, you were a person who owned rental houses. After this, you are operating a small commercial real estate business. The distinction is not cosmetic. The financing is different. The insurance is different. The tenant profile is different. The management overhead is different. For the first time, you hire a part-time property manager. You pay her $340 a month. She is worth 3 times that. The third rule: below 5 units, you are a landlord. Above it, you are building a business. The moment it becomes a business, your decisions change. The language changes. The leverage changes. The way banks look at you changes. Your combined portfolio now generates $7,140 in monthly gross rents. Net of expenses, debt service, and management, you are clearing $2,190 a month. For the first time, your real estate income has crossed 5 figures in a single year. You file taxes differently now. You have a CPA who specializes in real estate investors. She introduces you to cost segregation. You learn that the IRS allows you to depreciate a residential rental property over 27.5 years. You learn how to accelerate that. You learn what a Schedule E is and why it has been quietly reshaping your tax liability in ways you didn't fully understand before. The money you save on taxes goes directly back into the machine. You are 34, 9 units, total real estate holdings worth $1.1 million, outstanding debt of $714,000, equity of $386,000. You cross $1 million in real estate assets. The number lands in your chest like a fist. Not from pride, from weight. You feel the weight of it, of having built something real, something that existed on paper, and then in brick, and then in tenants' lives, and then in a number that you never once let yourself fully believe was possible. You feel all of that, and then you get back to work. You get a call about a 2-4-unit apartment complex. A developer is selling it off. He overextended himself during the construction boom and needs liquidity. The property is in a secondary market you've studied for 2 years, growing population, expanding job base, the kind of place where remote workers relocated during the pandemic and didn't leave. The asking price is $2.8 million. The cap rate is 5.9%. Occupancy is 91%. You know the market well enough to know occupancy will hit 96% within 14 months if you make 2 operational changes the current owner hasn't made. You have run those numbers enough times that you can say them without looking at your notes. You cannot do this alone. You have never syndicated a deal. You don't fully know what that word means in the legal sense yet, so you spend $4,000 on an attorney who does. You bring in 3 investors from your network, people you've been building relationships with quietly over 4 years, people who have capital but not time, people who trust you because you've shown them your track record instead of just told them about it. You raise $680,000. You close on the 24 unit. You are the general partner. This is a different version of you than the one who was afraid to call a woman about a duplex 6 years ago. The 4th rule. The deal you get into matters less than the terms you negotiated to enter it. Equity, cash flow, and control are 3 separate things. Most investors think they want cash flow. What they actually want is control. Understanding the difference is the difference between building wealth and just building income. At 37, your portfolio holds 47 units across 6 properties. Your annual net operating income is $310,000. After debt service, you net $148,000 from real estate. That number has crossed your salary. You don't make a big announcement. You don't post about it. You tell your spouse over dinner on a Tuesday. She already knew it was coming because she's watched you run the numbers every weekend for 7 years. You have a conversation that night about capital allocation, about which properties to sell, about leverage ratios in an uncertain rate environment. This conversation lasts 3 hours. It is one of the most important conversations of your life, and it happens at a dinner table in a house where nothing particularly remarkable is happening. That is what the real version of this looks like. You sell your first duplex, the one that started everything. Your basis in that property, after depreciation, is $47,000. You sell it for $319,000. You execute a 1,031 exchange. Roll the proceeds directly into a 32-unit in a market where rents are 14% below comparable cities with identical economic fundamentals. The market hasn't caught up yet. You believe it will. You are buying time as much as you are buying real estate. Your net worth crosses $2 million. The number lands differently than you expected. You thought it would feel like an arrival. It feels more like a checkpoint on a longer road than you originally imagined. You start getting to know people who operate at a different altitude. Not celebrities, operators, people who own 200 units, 400 units. You watch how they think, not what they own. How they think. The pace is different. The patience is longer. They are underwriting deals years before the deals become available. They are building relationships with sellers, before sellers know they want to sell. They are managing capital with position sizing, correlation analysis, exit strategies built in before the entry is ever made. You raise a small fund, $4.2 million from 12 investors who have watched you operate for a combined 11 years. You deploy it into 2 value-add multifamily acquisitions in adjacent markets. You bring in a full-time asset manager. You implement property management software that your 9-unit portfolio didn't need, but your 160-unit platform absolutely does. The distinction between investor and operator has fully collapsed. You are both. The machine is no longer something you built on weekends. It is an institution. Small, but real. The 5th rule. At 10 million in real estate holdings, your reputation becomes a financial instrument. Brokers bring you deals before they hit the market. Lenders call you. Sellers take your offer over a higher number from a stranger because they know you close. That trust was not purchased. It was accumulated at the rate of one kept promise at a time, over a decade, in markets nobody was watching. At 43, your portfolio holds 218 units across 4 markets. Total asset value, $31 million. Debt, $19.4 million. Equity, $11.6 million. Net worth, including everything outside real estate, $14.1 million. The exact figure is known to your attorney, your CPA, and your spouse. That's it. You have stopped measuring yourself by it. Not because it doesn't matter, but because the number stopped being the interesting part. The structure is the interesting part. The velocity is the interesting part. The way capital moves and compounds and creates options that didn't exist before is interesting in a way the number itself no longer is. You are in conversations about a 300-unit ground-up development deal. You have never developed from the ground. You hire someone who has. You bring in an institutional equity partner who takes preferred returns and hands you the development fee and a piece of the back end. You learn more in the 18 months it takes to break ground than you learned in the previous 5 years combined. The entitlement process alone is a graduate-level course in municipal politics, zoning law, and the space between what a city says it wants and what it's actually willing to approve. You lose 6 months to a council vote that goes the wrong way. You don't panic. You don't sell. You adjust the plan. Come back with a redesign, re-present. The project moves. The development delivers. 94% leased in the first 6 months. The city that fought you is now using your building in their economic development materials. You do not feel vindicated. You feel focused. There is another deal already on your desk. You exit a 72-unit complex you've held for 9 years. The proceeds, structured through a Delaware statutory trust, are $7.4 million. You redeploy into a preferred equity position on a large industrial conversion and into a cash-flowing mobile home community that produces returns most people overlook because they've decided the asset class doesn't sound sophisticated enough at dinner parties. You make decisions based on fundamentals. Prestige is for people still trying to impress someone. You stopped doing that around the time you cleared your first million. Your annual distributions to yourself are $1.1 million. Most of it goes back in. You've lived in the same house for 11 years. You drive a truck you've owned since 2019. You take your family on one significant trip a year. This is a choice, not a constraint. The difference between those 2 words is, in a very real sense, the whole point of everything you've done. The 6th rule. Above 50 million. You are not an investor. You are infrastructure. Cities plan around you. Lenders structure products for you. The market doesn't overlook you. It incorporates you. You are 51. Your portfolio spans 700 units across 9 markets. Total real estate asset value, $87 million. Equity, $39 million. Net worth, $52 million. You have a staff, an asset management team, an acquisitions director, an in-house CFO overseeing 13 LLCs and 2 operating funds. You attend a meeting in a room with 7 other principals. Combined, those 7 people control $2.1 billion in real estate assets. The conversations in that room are short. The decisions are fast. The money moves in sizes that would have seemed fictional to the version of you who checked Zillow from a rented couch. You mentor 2 people who remind you of who you were at 27. You are specific with them. You don't give them motivation. You give them math. You show them the actual numbers from your first duplex. The $486 a month. The 7.1% rate. The terrifying, clarifying moment you handed someone the keys to an apartment you owned and felt that strange, quiet pride. You show them the spreadsheet from the unit negotiation, the 6 weeks of underwriting, the $38,000 you took off the price because you did the work and knew more about the property than the seller did. You tell them what nobody told you. Real estate rewards the specific. The person who studies one market, one set of fundamentals, one type of asset until they know them in the dark, that person is still at the table 20 years later. The person who was waiting for perfect conditions has been waiting this whole time. And somewhere in this city right now, there is a 27-year-old lying on a rental couch. Their apartment costs $1,470 a month. They are opening Zillow and looking at a home priced at $408,800 and doing the math that doesn't work. They are telling themselves they're being smart. They are waiting. The moment is not going to get more right than it is. The 30-year fixed rate is 6.37% this week. It was 6.62% a year ago. It might go lower, it might go higher. The market is not pausing for anyone's savings account to catch up. The question is not whether the moment is right. The question is what the next 20 years looks like if you keep waiting for it to be. The machine doesn't run on confidence. It doesn't run on inspiration. It runs on the first small, terrifying, specific decision. A duplex. A phone call you almost didn't make. A down payment that takes you to zero. After that, someone else starts paying your mortgage. After that, the math starts running in the right direction. After that, you start understanding what the word asset actually means when it belongs to you, when it was built by your decisions, when it runs on a Tuesday afternoon while you are doing something else entirely. The balance is $408,800. It always starts there. It always will.